So there are 6 of us are here. We should be having 9 people. So I think should we wait for 2-3 minutes more, or should we? Let me just recap what we did yesterday. And let me just take you through this, what we were doing in capital budgeting yesterday, so that this is the part which. So in capital budgeting, what were we basically discussing? This is about, I have a certain amount of long-term capital. The source of this capital, when I started my company, I had this whole plan in my mind that this is what I want to produce. Let us say it's a manufacturing company. This is what I want to produce. And if I want to produce this, I need so much funds. And if I need so much funds, I arrange these funds from other shareholders. Some of it I arranged from people who are willing to lend the money to me. All this was done. And now I have the capital with me. Now the big challenge for me is, how do I ensure that I choose the right projects? That means I spend the money in the right way. So capital budgeting, like any budgeting, is basically a way of planning how to use your finances. The only thing in capital budgeting is that it is specifically directed towards the corporate goal. The company has a certain goal. Now, to achieve those goals, how should it best spend its money, especially the long-term funds? This is specifically about the long-term funds. Now, in this, we said that there can be various stages. You identify, you estimate the cash flows. I think all of you must be very clear about cash flows by now. Inflows, outflows. We evaluate different projects. For example, yesterday when we mentioned these different methods, IPV, the NPV, net present value, we spoke about the internal rate of return. These are different ways of evaluating projects. To understand whether these projects are, what sort of return these projects will give. And then we select the project, we implement it, and finally we perform a post-completion audit. See, almost all companies in India, not almost, all, at the end of any financial activity, there will always be an audit. And the auditor is someone who is not a part of the company. This person comes in from outside, and he comes and he tries to see whether you have basically accounted for all the expenses and income in a manner which is transparent. That is the basic purpose of an audit. And then when the person is satisfied, he gives a certificate that yes, this audit has been done. And that certificate is generally the basis for which the financial results are published. Before the publication, it has to state that it has been audited. The auditing firm is a responsible firm. So that this entire stage of capital budgeting is completed when the audit is also done. Now here, yesterday we said there are 3 methods which we want to discuss: payback, net present value, and internal rate of return. Yesterday we discussed net present value and internal rate of return. Today we will look at this payback method, and there is one more which I have not mentioned here, called the profitability index. That is also based on the NPV concept. So we looked at, this is not so important. Let's just go to this. So we looked at this. This was the first of the examples that I had given you yesterday. And we took this example of a 10 lakh investment with cash inflows of 3 lakhs, equal amounts, 3 lakhs each year for 5 years. We discounted this. That means we divided it by the opportunity cost. What is the opportunity cost? If these persons had not, if you had not invested in this particular project, this 10 lakhs could have been invested somewhere else. So what would have been the amount of interest you would have earned in that alternative opportunity that you had? So that we are assuming in this case, you could have earned 10% if you did not put the money in this machine, in buying this machine. And so we discounted it. Anjan, for you, these figures which are here are basically 1.10, 10% interest, in decimals 0.10, add 1 to that, so that becomes 1.10. 1.10 squared is 1.21. 1.10 cubed is 1.331. 1.10 to the power 4 is this, and to the power 5 is this. So you divide each 3 lakhs with this, you get the present value. What we all should again note is that as these cash inflows come at a later period, the actual present value goes down. So the first 3 lakhs, which comes after 1 year, it is 2,72,000, just to take a round figure. But in the 5th year, 3 lakh rupees, its value, its present value is only 1,86,000. And then when we add all these two together, we get this figure, 11,37,000. And this figure that we get out here, this is the present value of all these cash inflows, the total. Now everything is in terms of present value. 10 lakhs is in terms of present value. All my cash inflows are in terms of present value. So now everything is equal. And now I can simply do a simple subtraction and see whether I will gain anything through this exercise or I will lose. And when I see this, it's 1137 is more than 10. I see that my NPV is positive, 1,37,000. Therefore, I feel that this is a good investment, because this means that I will increase my wealth at the end of 5 years by 1,37,000. And I'm calculating this not in terms of future values, but in terms of the present value which I will get. So this is the basic thing that we discussed yesterday. And therefore, there is a case to be made for accepting this project. Now, then we said, let's take another case. In this case, instead of these 3 lakhs being received in this is a total of 15 lakhs. If you just take it in terms of, the future value terms, it is exactly 15 lakhs. So we said, instead of getting these 15 lakhs in 5 years at the rate of 3 lakhs per year, suppose we get it at the rate of 1.5 lakhs in 10 years. We took that example here. And then here we said that if we now do the same discounting, same 10% discounting, so 150 divided by 1.10, I get 1,36,000. Then it becomes 1,23,000, then 112, and so on. And finally, 10th year, 1,50,000 is worth only 57,831. So the value of money keeps going down. Present value keeps going down. Now, if I add all this up, I get 921. So what does this present value method tell you? That if you consider the timing of the inflow, then you realize that it is better to get something early than to get it late. And if it comes very late, then like this case, instead of 5 years, it's coming in 10 years, then the same project is not worth it. Because see, you can see now that you invested 10 and you got back only 9,21,000. You made a loss of 78,315. So this same project, but the cash flows now spread over 10 years instead of 5 years, does not make sense. This is the value of considering the timing of the cash inflow. This is one of the big principles in finance. And time value of money. Okay, so this was one. And Then we also discussed this other method, and where we said that what is internal rate of return. So we said,
Sorry, sir.
yes.
Sir, sorry to interrupt you, sir. I have one question. Sir, like what is discount like denoting here, sir? Like, so what do you mean by discount here?
Can you repeat that, please?
So what do you mean by discount here, sir? What is discount actually?
Discount is just the technique. See, remember when we were beginning this, let me just take you back to the slide. Okay, Saurabh, let's revise this slide.
Okay,
we said that we took future value, present value. Okay. So in this case, we said that suppose today we have 10 lakh rupees, 1 lakh rupees, and we put it in a bank, let's say at 10% interest. Now, if I want to calculate this, what do? I take 1 lakh and I multiply it by 1.10. So at the end of 1 year, what is the amount that I get? I get 1,10,000. And I call this my future value. Now, if I reverse this, suppose I say that 1 year from today, I will get 1,10,000. I have nothing today. Somebody comes to me with this proposal, you do this job for me, I will give you 1,10,000, but I will give it to you after 12 months, after 1 year. Now I tell him, look, I've just learned this principle of discounting and I want to understand what is the present value of this 1,10,000, which I will get 1 year later. So what do? I simply reverse the process. Since I am assuming that this rate of interest is 10%, I divide 1,10,000 by 1.10. So basically, discount, see, when you say discount, what do you mean? It means that you are reducing something. Now, in this particular case, why are you reducing it? You are reducing it because you are receiving it after a certain period of time. Therefore, there has to be a discount. It has to be reduced to its present value. And this reduction is done by dividing that future value by the rate of interest that you expect to earn on that money. Suppose you had that 1,10,000 with you today. It was possible for you to invest it at 10%. But you're going to receive it 1 year from today. Therefore, what you do is you take the 1,10,000 and you divide it by 1 plus 0.10. And that process is referred to as discount. It's a word in finance, the meaning of which is to reduce something to its present value, to reduce a future inflow into its present value. Is that clear, Saurabh?
Understood, sir.
It's just a word you have to accept. But all of us know discount. Discount means reducing. So in this case,
sir,
it's being reduced. That's all. Okay.
Okay, sir. Thank you, sir.
Now, coming back to this. Okay, so here, in this particular case, this internal rate of return simply means you invested 10 lakhs. In our first example, we said we are getting 3 lakhs in 5 years. And in that, we were able to basically see that we made a profit in the sense that our wealth increased to 11,37,000 from 10 lakhs. In the second example, when we said we are getting 1.5 lakhs in 10 years, we found that our wealth decreased because from 10 lakhs, it went down to 9,21,000. And we found that we had made a loss of 78,000. Now, there can be, if you just think about this, there can be a certain rate of interest. If I discount all these 1,50,000 cash inflows with that rate of interest, which will ultimately result in in the total of the cash flows becoming 10 lakhs exactly, which means that the NPV will be 0. Theoretically, it's possible. Now, it can be more, it can be less. So there has to be a rate of interest. So at 10%, 3 cash flows coming in 5 years, discounting rate 10%, we found that we are positive. From 10, we are going to 1137. Now, in 10 years, 1,50,000, discounting rate 10%, we found that we are going below 10 lakhs, from 10 to 921. So what is the rate at which the present value of all my future cash inflows over those 10 years will be exactly 10? Whatever that rate is called my internal rate of return. Now, in this particular case, I used Excel to calculate this rate. Rate came to 8.144. And I discounted each of these cash flows. It's a one way of checking also if the Excel calculation is correct. And then what I did was I simply divided each of the cash flows or discounted each of the future cash flows by 1.08144 or some factor of 1.08144, squared, cubed, to the power 4, to the power 5, and so on till I come to the 1 to the 1.10 to the power 10. And I find that if I add all these up, I'm getting exactly 10. NPV is now 10 minus 10, which means it's 0. Therefore, I call this rate, 8.144, my internal rate of return. What does this tell you, this internal rate of return? This is telling you that if you have some other project which will give you more than 8.144, you should invest there. It is also telling you one more thing, that in case you decide to invest in this project, the cost of capital for you, suppose you are borrowing money from somewhere, that cost of capital should not be more than 8.44, it should be less. Because if it is more, you will make a loss. So basically, we are only using the discounting method, the NPV method, but we are just looking at it from a slightly different angle. Instead of looking at the amount, we are looking at the rate. Is this clear to everyone? Any doubts, anyone?
Yes, sir.
Okay. Then in that case, and this is the Excel formula for calculation of IRR. So I invested 10 lakhs. In this particular case, I have taken 3 lakhs over 5 years. You can do the same calculation for 150 for 10 years. You just have to write it, you will have to extend the number of columns. And then the formula is equals to IRR, open brackets. You start your selection from this place, A1, this one, and you go all the way to F. F, you just go to be on the safe side, go up till here, F3. Cover this entire range, first 3 rows. Close the bracket, and you will find that the IRR is 15.24. So in our first example, where we saw that the cash flows were coming in 5 years, and we also found that we had made a profit. Remember, it was 10 lakhs. From 10 lakhs, we went to 1137. What was the rate of return in that case? The rate of return in that case was 15.2. And our opportunity cost was 10. So 15.24 is more than 10. So that way, you can convince yourself that yes, this is a good project to go for. Because the IRR is also positive, the NPV is also positive. So these are 2 ways of capital budgeting. Now, this same NPV method can be used in a third way. Calculations are the same. But look at this one. So this is based on a ratio. It is known as profitability index. What is this? It is the ratio of the present value of the cash inflows, like 3 lakh, 3 lakh, 3 lakh, 3 lakh, present value, and the initial cash outflow. Like in our first example, we saw that the total present value of our cash, future cash inflows was 11 lakh 37. And our initial cash outflow was 10 lakhs. We had invested 10 lakhs. After 5 years at 3 lakhs per year, we were able to get back 11 lakh 37. So basically, what am I doing here? I'm dividing 10 lakhs by 11 lakh 37. Okay? And here it is again. See, 10 lakhs. Here in this particular example, what have we done? We have, just for a bit of change, I gave you an example here where the cash flows are different in each year. So in the first year, it is 250. Second, it is 280. Third, it is 350. Four, it is 3 lakhs. 5, it is 250. So remember, in the other two examples, the cash flows were equal. But the system works just as well when the cash flows are not equal. Now, in this case, again, I assume that my opportunity cost is 10%. So 0.10. So I divided each of these or discounted each of these by 1.10 or a factor of 1.1. And 250 discounted by 10 becomes 227. 280 discounted by 1.21, which is 1.10 multiplied by 1.10, becomes 2.31. 350 becomes 2.62. 4 becomes 2.04. This becomes 1.55, and our total becomes 10,81,772. NPV is positive, 81,722. If I now divide, I will get 1.081772. Okay. This is the basic concept of profitability index. What does this tell you? If you are getting a profitability index which is greater than 1, it means you can accept the project. This means that you are increasing your wealth. It is going to increase. If it is less than 1, in other words, suppose it's reverse. You had invested this and this is the amount you got. You are getting a figure which is less than 1. Then you should reject it. And suppose you get exactly 1. This can happen, like IRR exact, you get the same thing. Then what happens? Then in that case, it will depend on non-financial factors. If there is some other reason for you to do the project, something which is good for your company, and you know that at least I'm not going to take a loss on this, then you may accept. But by the same token, you can reject it also on that one. But essentially, the finance is telling you that, okay, you are not going to make a big profit here. You will just get back your money. That's all. So it's up to you, the board of directors now, to decide whether they want to go with this project or not. Maybe the project is giving you very positive publicity. It's a green project. It is something the government is after you to take up a project of that sort. And let's say the government, puts a lot of pressure on an automobile company that you must produce electric vehicles. And they do the analysis and they find that their profitability index comes to 1. So now what will basically be the deciding factor? They know that they won't make a loss. But at the same time, there is a lot of pressure by the government. So they say, okay, fine, good to keep the government happy. Let me approve this project. At least I'm not making a loss. So this concept here is known as a profitability index. Anything above 1, you can accept. Anything below 1, you should reject. If it is exactly 1, then of course, you decide based on the totality of events. So it recognizes the time value principle, like NPV and IRR. It is consistent with value maximization. What is value maximization? My wealth should increase. Basically, if the NPV is positive, it means that my overall wealth is increasing. The index can be used to compare projects. Just like NPV can also be used to compare projects. Let's say I have 5, 6 projects. I do this calculation for all 5. And then I place the figures in a table. I can now look and see, as per if my calculations are correct, then which of these projects are going to be better. This is the concept here. Is this clear to everyone? This part?
Sir, one
Yes,
question over here.
Yes, Dheeraj?
Sir, once we are finding NPV, then going it to the this index, we can get the if it is advisable to go or not. So this additional terminology, why we are using it, is the main purpose.
See, it is just a matter of presenting it in different ways. It's all. Otherwise, if you look at this, if you just get NPV, that itself is sufficient. And all these things are only using the NPV. It is like, Dheeraj, it's a way of presenting. Look, these are the different ways in which we can look at. NPV is positive. If I reduce it to a ratio, I'm getting something more than 1. I invest 1, I'm getting more than 1. Think of it like that. So when you're making a presentation to a board of directors who are not all finance people, then it makes, you don't know which one will click now. Think of standing before people who will decide and you give them all the figures. It will make you look more competent also. Look, these are different ways in which we have calculated. Okay, that's all. Otherwise, the sum and substance of it is the same. You should understand the discounting which is happening. You should understand the net wealth which is increasing. That is all. Whether you present it through IRR, whether you present it through NPV, or whether you present it through PI, basic method is the same. In each case, you are considering the timing of the cash inflows, and you are, based on that, you are discounting them, and you're arriving at a result. Okay? Now,
sir, one more thing.
Yes,
sir, one small thing. Sir, in all the cases which we have discussed since yesterday till today, we are considering all the investment at the upfront. So in the first, we are considering the investment of 10 lakh. And suppose this will be getting it through the 5 years or 10 years. Suppose 5 years of the projects, we keep on investing the money at different point of time. Suppose we invest 20% amount at the upfront, then after 2 years we put some more money into the project, then after 5 years we put some more money into it. So then
the only difference will be the method will remain the same. Your calculations will become more elaborate. That's all. See, you will be using the same method, but the difference is that the calculations then will become more elaborate. Like, for example, if you are going to invest 10 lakh rupees today, 5 lakh rupees after 2 years, then remember the 5 lakh rupees after 2 years, its present value will also be less. So
correct.
If you then invest another 5 lakh after 4 years, then the value of that 5 lakh present value will again be less. See, the purpose is you bring everything down to its present value. Then you can have a column for outflows, you have a column for inflows, and you total the two and see what happens. That's all. You get this point? If you are going to invest in the future, then you are investing less than the value today.
Present value.
Because value of that outflow is also going down. So there will be no, it is just that you will have to make a longer calculation. But right now, the purpose for us is to just understand that anything which is happening in the future has to be discounted. Why am I discounting? To make everything at today's value. That is the basic thing. Then everything is equal. If something is coming in the future, something is coming today, then they are not equal. The values of these two amounts is different. In discounting, what I am doing is I am making all these values equal. And when everything becomes equal, ultimately it is a matter of subtraction only. I just have to subtract the result from the original, and then I know where I am. Okay. Now we come to a simpler method. See, this was the tough one, discounting. This is our payback method. The payback method is something which is so simple that it really doesn't take any sort of financial expertise to do. What is payback method? In how many years will I get back my money? Simple. The number of years required to recover the original cash outlay invested in the project. That's all. I do not consider the timing. I don't consider anything which is a little complex. I'm just looking at one simple, it's like a back of the envelope calculation. I am investing 10 lakhs today. Okay, these are my estimates of what I'll get in the future. So in how many years will I get it back? I have a certain number of years. Okay, this year I'll get it back in 2 years, I'll get it back in 3 years. If I have 2 projects, the project which gets it back to me faster, that is the project which I will favor. So here is the example. If the project generates constant annual cash flows, then the payback period is calculated by dividing the cash outlay by the annual cash invested. Okay, suppose the cash inflow expected is 12,500 per year and a life of 7 years. The initial investment was 50,000. In how many years will you get back your money? So the original cash outlay was 50,000. You are dividing it by since it is equal, by the amount of cash inflow expected every year, 12,500. So that means in 4 years, you will get back your money. So if you are comfortable with this, then you can take a decision on this basis. Okay, this project makes some sense. I'll get back my money in 4 years. After 4 years, whatever I get is a profit for me. But remember, I am not considering timing. Here, I am not considering timing at all. It is a simple calculation. Like I said, it's like a back of the envelope calculation. Okay.
So I have a question.
Yes.
So we won't be able to know that we will get more than 50,000 and less than 50,000. We'll just recover that amount in certain number of years.
No, you know that the life of the project is 7 years, no?
Yes.
So since the life of the project is 7 years, you know that you will get another 12,500 into 3. That extra you will get. So 37,500 you will get over and above your initial investment if you continue for 7 years. Okay, fine. So then,
sir, can we?
Yes.
Sir, can we say this is a break-even point?
No, this is not break-even. You can think of it as break-even point. Break-even point actually is in a different context. Break-even point is used in the case of a number of units. Like let's say that it's a manufacturing, concern, enterprise. It's a factory, it's manufacturing items. Now, what basically happens is there is a certain fixed investment and there is a certain variable cost. Fixed investment is, let us take it simply, all the machines and everything, factory buildings and all this is fixed. So after that, depending on how many units you produce, you will be able to get back a certain amount. You'll make an earning, but your fixed investment will not change. So you will not have to buy more machines. You will not have to build a new factory. That is fixed. What will change? The raw material cost will change. The overhead cost will change. Like for example, the fuel costs, electricity costs, that sort of thing, maintenance costs, that will change. So the more you produce, the more the variable costs will keep on increasing. Now the break-even point in that particular case is, at how many units do I reach a no profit, no loss situation? So if you find that if I produce 1 lakh units in 1 year, I will then reach a position where my input and output costs are exactly equal. That is my break-even point. That means to make a profit, I have to produce more than 1 lakh units in 1 year. You get the point, Saurabh?
Yes, understood, sir.
It is a different calculation. It's a different, right now in this, we are not considering break-even. This is very simple. This is simply, in how many years will I get my money back? That's all. There is no complication here, nothing.
Okay, sir. Payback period, right? Understood, sir.
Then, so look at it like this. Suppose the cash inflows are uneven, not equal. In that case, we can manually calculate the payback. See, like you outlay is 20,000. Year 1, you get 8. Year 2, you get 7. 8 plus 7, 15. Year 3, you get 4. 15 plus 4, 19. And year 4, you are getting 3. So 22. So that means when are you getting back your 20,000? Sometime during year 4. So the initial investment is recovered during year 4. So according to the payback method, all that is happening is, it is telling you that it will take you these 3 years and some months to get back your money. Now this is all. This is not too much information. Little bit of information you are managing to get from this calculation. Okay. What is the positive? It is simple. Simple to use. It can't be simpler than this. Think of it this way. Risk of the project can be tackled by having a short payback. Normally people say that if you put an investment into a project, the shorter, the faster you get back your money, the less risk you have. Okay, so this is an old principle. Like for example, people who, when this NPV concept was not there, when people did not know about it, what was the basic parameter for understanding risk? So the basic thing was, as soon as I get my money back, think of it like this. If you invest in the stock market, anybody invests in shares? Dheeraj, I think does something. So you do it also.
Right, sir.
Now suppose you buy Tata Motor shares and you buy it for, let us say, 100 rupees per share. Okay, I'm giving you a ideal sort of situation. You buy it for 100 rupees per share and you buy 100 shares. Now, after some time, you find that it becomes 200 rupees per share. So one way of de-risking yourself is, if I sell 50 shares now, I'll get back my investment. And 50 shares, there is a chance that the price will go above 200. So those 50 shares I can use for getting a riskless profit. You understand what I'm saying?
Yes, sir.
So this is just like that. Okay, fine. I'll get my money back in so many years. Anything I earn after that is pure profit for me. And if the money comes back to me faster, then I am free of risk faster. It becomes risk-free from me from that point, because I have got back my money. What have I not considered? I have not considered that the present value of that. That's all. But if I'm not so interested in those things, I say, we don't need to think about all those things. Let us simply just think about the money itself, the absolute value of money. Now, emphasis is on early recovery of the initial investment. It gives an idea of the liquidity of the project. Liquidity is what? The availability of cash. So you invested 20,000. You got back your 20,000 in 4 years. You are out of cash for total 20,000 or out of it for only 4 years. 8 you got back in the first year itself. So your shortage was 12. You got back 15 in the second year. You're only 5,000 less. Third year 19, only 1,000 less. So liquidity point of view, you know exactly where you stand. And by the fourth year, you have got your money back. So liquidity is again 100%. Whatever you invested, you got back. This is the positive side. Negative side, it does not consider cash flows after payback period, does not consider timing of cash inflows, as it does not consider time value. Okay. So the point which Samriddhi was making, that what about the cash inflows, cash flows after? Since we are not so interested in that part, all we are saying is, I get my money back, I am risk-free now, liquidity position is okay, whatever I get, that is a profit for me. So it is not considering that at all. Whereas in all our NPV calculations, we were looking at the cash inflows through the life of the project. This particular case, that is not happening. Okay. Now, let us look at another thing of payback. Let's take two projects. Okay, so you have A and B. The outflow is here, year 0, minus 4,000. Year 1, in project A, nothing comes. In year 2, you get 4,000. In year 3, you get 2,000. What is the payback period? 2 years. Okay. Year 1, year 2, 4,000 you invested. When did you get your 4,000 back? In 2 years. So your payback period is 2 years. Now you take project B. In this case, you again invested 4,000. In year 1, you got back 2,000. Year 2, you got back 2,000. Year 3, you got 0. Here also the payback period is 2. So if you are going to compare using the payback period, it basically, these two are equal. But suppose I now use the NPV method also, and I discount these cash flows. I discount these cash flows by 10%. That means I'm dividing 4.10 by 1.10 into 1.10, 1.21. And I'm dividing 2,000 by 1.10 to the power 3, that is 1.33. If I do all that, then I find that my NPV, I get the total value of this, minus 4,000. My NPV is 806. That means I'm actually increasing my wealth by 806. In the second case, when I'm getting it like this, 2,000, 2,000 and 0, I find that it is negative. Same 10%, the same NPV principle is used. So what was looking to be okay, almost the same, here I find that it is negative. So if I add NPV to this, I am able to see that the method is defective. You know, the payback method is defective because it is not giving me the full picture of the thing. Are you getting this? See, NPV is being added here only to show you how NPV is exposing the weakness of payback period. That's all. But since we understand NPV, we can very easily appreciate that yes, this one is better, A. Okay. Now, let's take this. Same thing. We use the same methods. So in this particular case, project C, we invested 5,000. Project D also we invested 5,000. And here see we are making a marginal difference here. 3,000, 2,000, 2,000 in project C. Payback period 2. NPV comes to 881. Again, we are discounting by 10%. In D, same thing, 5,000. Here it is 2,000, 3,000, 2,000. Slight difference. Okay. Here, the NPV comes to 798. So, but the payback is still 2. Because the payback has only one concern. When will I get back my money? That's all. Because once I get back my money, I am now free of any chance of loss. There is no risk of loss. I have got back my. But have I increased my wealth? That question, payback does not answer. Okay. So, this is why payback is not a measure of profitability, because it does not tell you about the wealth part. In the long run, are you increasing your wealth or not? Okay, now to continue with this, there is one more slide here. So somebody said, let us have a discounted payback method. And let us see if the discounted payback actually works. So we have already used the discounted payback there. So here what we did was, we have the present value of the cash flow. So project P, we invested 4,000. In year 1, we got back 3. Year 2, we got back 1. Year 3, again, we get 1. Year 4, we get 1. Simple payback. When am I getting my 4,000 back? In 2 years. 3 plus 1. I have got back my 4. So simple payback tells me that I am getting it in 2 years. If I look at actual, the actual present value of these cash flows, year 1 I am getting, after discounting, 3,000 divided by 1.10, I am getting 2727. Year 2 I am getting 826. Year 3 I am getting 751. Now if I add this, what I am getting is these 2 and this, some part of this, 2.6 years. Now if I look at the NPV of this at 10%, what does it come to? It comes to 987. That means I'm adding all this, reducing this 4,000. I'm ending up with 987. Now here is my project Q. 4,000 investment. Cash flows are different. Year 1, it is 0. Year 2, 4,000. Year 3, 1,000. Year 4, 2,000. If you go by the simple payback method, you are getting your money back in the second year. You invested 4. By the second year, you had got back 4. So this is, you have got back your 2. Now in these 4 years, if I look at the present values, I'm again discounting by 1.10. When am I getting my money back? It is 2.9 years. And what is the NPV? It is 1421. So what does this tell us? As per simple payback method, both projects are equal. You can take your pick, P or Q. In both cases, you will get your money back in 2 years. As per the discounted payback method, project P is better because the payback period is less. See, here, if you go by the payback principle, here you are getting it back in 2.6 years. Remember, this NPV method is something which we are putting additionally. Somebody who's using a payback method is not supposed to be looking at NPV at all. So if we look at this way, then we find that project P is better because the money comes back to you faster in project P. Project Q, it is taking 3 months more. So it's not that good. But if I now look at it from the point of view of profitability or creation of wealth, then I find that basically project Q was better because here I would have made 1421 rupees over the entire period instead of 987. So this discounted payback method also has a problem because it is not allowing you to look at the creation of wealth. Are you getting this? Simple payback method, 2 years. both projects. So it is not helping you to choose. You can pick anyone. Flip a coin, whichever wins, heads or tails, you can do it. Discounted payback method, you should go for P because you'll get your money back faster. But if I was to use an NPV calculation, I would have gone for Q because my wealth creation would have been high. Okay. Time value of money, we need not discuss because we have already done this. I'll send this over to you. And now we can come to financial statements. Now, financial statements, basically, there are three major financial statements. I won't, I'll just send this to you. You can look at these things, on your own. I'll just read it out to you. It is nothing complex. There are four components of accounting. One is bookkeeping. Bookkeeping is simply compiling data with regard to the transactions in the company and arranging them in a systematic way. So whenever, you maintain a journal. Whenever any money goes out, any money comes in, you journalize it. You maintain a journal. And you basically, in that journal, you maintain what was the purpose of the outflow and what is the purpose of the inflow. And according to that, you maintain some accounts. Okay. Financial accounting is the submitting financial reports to those who need to know. Now, this is a very general term. Submitting financial reports. What are these financial reports? These are basically three: the balance sheet, the profit and loss account, and the cash flow statement. Now, any company which is registered with the registrar of companies, they are required to prepare these three statements: balance sheet, profit and loss account, and the cash flow statement. And all three have to be audited. All three have to be audited by an independent auditor, somebody who does not work for the company. He will come and see whether it is correct or not. Or are you trying to hide something? Are you trying to misrepresent something? And if the person is not satisfied, what will he do? If an auditor comes, see, the worst case is he will refuse to give he'll put his stamp on your annual statements, which means that you will not have complied with the rule of getting your financial statements audited. So then it becomes an illegal thing. Or he can put his stamp, but he can qualify qualify his report or the certificate. How will he qualify it? He will basically say that, yes, I have audited, but there are these weaknesses in the reports. And it is for the company to then satisfy its shareholders that they are taking steps to remove those weaknesses. So that is financial accounting. Management accounting is related to the management of funds that are known only to the insiders. Management accounting is more about costing. It will consider things which are not to be made public knowledge. This is entirely for the people who are running the company. And the purpose of this is basically to use finances in a more efficient way. You try to reduce wastage. You try to do all the things that can make you more profitable. That is the purpose of management accounting. And then, of course, income tax accounting, computing the tax that needs to be paid and how it can be managed best. So these are the four basic components of accounting. Now, the one which we will look at today, what is important for us is these three, because these three are mandatory. you have to prepare these, and these have to be submitted after audit to everyone who needs to know. Now, who are the people who need to know? Can one of you try to answer this?
Board of directors, shareholders, auditors.
Board of directors have prepared it. Remember? So, board of directors is an internal thing. Obviously,
Registrar of companies.
Okay, one registrar apart from the internal registrar of companies, then
Promoter, and in market we also float, not float, but our shares and market value is discussed on the basis of the balance sheet and then
okay, yes.
Investors, sir.
So the shareholders have to know about it. The market analyst has to know about it.
Investors.
Huh?
FII, sir, investors.
Yes. Whether, see, any shareholder, whether he is from, let's say, a foreigner, whether he is internal, they have to know about what you are doing. Anybody who is putting money in the country. All of you are missing one category.
The bank.
The
bank.
Yes, the bank. See, the bank is most interested, na? Because the bank has given money. And the bank is the person who is really at risk here. Because the shareholder will normally have a small amount involved. The banks normally have very big amounts. If you read the papers, you see how much loss the bank takes in certain cases. Because their money goes there. So they are the most interested in this, what is happening. So these are some of the stakeholders. Other stakeholders, internal, but not completely internal, are the employees. See, the employee is also very important. And finally, at a very broad level, the government also is interested. If the company is big enough, the government is also interested in knowing, because big companies give employment to very large numbers of people. And if these big companies misuse the funds, to some extent, there is going to be a problem at a very large level. So the government also has an interest. Obviously, that will be routed through the registrar of companies, etc. For listed companies, SEBI is also an interested party. Security and Exchange Board of India also is an interested party when you are listing it on the stock exchange, because they also need to know whether you are making profits or not, whether you're simply misusing public funds, that sort of thing. Okay? So now that we know what these are, who are the people who have to know about this, let's look at these in a little depth. Okay? So let's take the first one. Balance sheet. But before we come to that, just some small points, expenditure, expense. So normally now we think of both of these things as being what? The same. In accounting, it is slightly different. In accounting, profit is not income minus expenditure. Profit is income minus expenses. Just remember this, because normally you will not be thinking about this. What is expenditure then? Expenditure if you take expenditure, some expenditure is made on assets. One category of expenditure is expenses. What is the difference? Assets are for items that are used to generate income. Like, for example, you buy a machine. If you are a service company, you buy, let's say, some computer servers. Or you buy intangible assets. You buy a software program. On the basis of these assets, you will produce something, either some finished good or some service. You will sell that to the public and you will earn some revenue. So basically the asset is anything which is used for the production of something which can be sold and which will generate income. Now, expenses are for items that are consumed. For example, this is very easily understood for each. Let's say it's a manufacturing concern. What are the items that are consumed? You have to pay salaries. Okay, so what are you consuming? You are consuming the services of your employees. You are consuming raw materials to produce the goods. You are consuming a lot of utilities. For example, for the space that you occupy, you are consuming that space, you are paying rent. You consume telecom services, you pay the telecom fees for that. So every single thing that you consume immediately, that means within that 1 year, the accounting period is 1 year. So within that 1 year, everything that you consume is an expense. And when I'm taking out profit, I am looking at this. See, if I were to consider the big expenditure I made on assets, investments which I made in assets, then every company will be in loss. Because your income in 1 year will never be able to match the huge investment you have made in your entire, in the big assets, the fixed assets that you have created. The land that you have bought, the factories that you have built, the equipment that you have bought, all that. It can never compensate in 1 year. So when I say profit, I am looking at the income in that 1 year and the expenses in that one. Okay, so when we come to the profit and loss account, we are looking at these two things, this part. Okay, what is happening to this thing? This asset part is reflected in my balance sheet. But this expense part is reflected in my profit and loss. Because these are all consumption stuff. This is all consumed. So in the balance sheet, I have my assets. And what else do I have in my balance sheet? I have liabilities. Now, what are liabilities here? Anybody wants to try this?
Long-term borrowings, outstandings, loan.
And what about short-term then?
Short-term also.
Short-term also, okay.
Yeah, borrowings.
Okay, fine. That is broadly correct. Think of it like this. Liabilities are sources of funds.
Current liabilities.
Yes, Samridhi.
Current liabilities.
Yes, current liabilities. We'll come to that, current liabilities. Those are the shorter term liabilities that have to be paid in 1 year. The long-term liabilities are those that are paid over a period of time, more than a year. Okay, now, liabilities are the sources of funds. When you set up your company and you wanted to do some activity, you had to get some funds. So when you got these funds, whether it was through shareholders who were willing to basically invest in your company, or whether it was through people who are willing to lend the money to you, these were all sources of funds that you got. Why is it a liability? Because you have to pay them back. See, the promoter's funds are also considered a liability because the company, remember, is a separate legal entity. Remember when we were discussing corporation, we said that the company is a separate legal individual. So since it's a separate legal individual, if it borrows money from the promoter, it is considered a borrowing. So equity from the promoter is also like a borrowing for the company. It has to be paid back. Hopefully the company does well, and from the profits, the promoter is able to get back the money. Yes? Okay. So liabilities are the sources of funds. Okay. And assets are the uses of funds. What do you do with the funds that you have? how do you use these funds? You buy something with it, right? You spend, there is expenditure. This expenditure means some cash outflow is taking place. Where is this cash coming from? From the liabilities. It can be long-term, it can be short-term. But it is coming from the liabilities. And you cannot spend more than you have. Therefore, the total assets is always equal to your total liabilities. It may be borrowed, doesn't matter, but they will always be equal. Okay, right? Now, so these are my basic. Let's not get into debits and credits right now. We will just stick to this. Balance sheet, liabilities, assets, profit and loss, income, expenses. Okay, so forget about the debit and credit part. DR is debit, CR is credit. It is an accounting convention. It doesn't really matter if the whole world reverse this, it will still work just as well. Okay. But we don't worry about that part right now. There are lots of rules: debit what comes in, credit what goes out, debit the receiver, credit the giver. But those will only make you feel, like this is a subject which you don't want any part of. That I don't want you to do. So basically, if we have understood this, we can then go to our the first important statement, which is our balance sheet. Now, the balance sheet is what? It is a statement of assets and liabilities as on the last day of the financial year, which is 31st March. 31st March, any year, it can be any year. On that particular day, what is the value of your liabilities? What is the value of your assets? Book values. We are not talking about market value. So the share price is not important. We are only talking about the book value. If you bought something, if you bought a machine, every year that machine is losing value. There is a process by which you reduce the value of the machine, which is called depreciation. But at the end of the year, you will have an actual number and a figure will be there. And that figure tells you that this is the value of my machine. Similarly, each and every asset that you have, whether it is an intangible asset, whether it is a tangible asset, that means even if it is a patent, even if it is a software, each thing is considered to lose value every year because every asset is supposed to have a life. When you buy a computer, the convention is that it has a life of 3 years. That means every year it will lose 1/3 of its value. So if it was bought, let us say, for 1 lakh, after 1 year, its value is 67,000. After the second year, it is 33,000, and at the end of the third year, it is 0. If the computer is still functioning, no problem, you use the computer. But as far as its book value is concerned, it is only 1 rupee. That means it is still being used. So as a token amount, you write 1. Point is this, that all the assets have values. Similarly, all the liabilities have values. If you have equity shareholders, they have given you money. And when we say equity shareholders, we are talking about the book value of the share, not the share price which is being quoted in the market. That will go down every 1 minute or 2 minutes. It keeps going up and down. I'm not interested in that. For accounting, I'm only interested in what is the value on my books. If I sold the shares at 100 rupees per share and I got 1 million shares, I have 100 million. That is my value. Remember when we were looking at the balance sheet of HCL, we saw that figure 271 crores, 543 crores. That is the book value of the share. That is the liability. Now, similarly, if I have taken a loan from someone, every year I am repaying. So by as on 31st March, the reduced value, my repayments, plus the interest, whatever is the balance, the bank will tell me that, that is the value of that liability. So for each and every item, assets and liabilities, I will basically take the value and I will write it down on my balance sheet. That is my balance sheet as on the last day of the month. Remember, it is only good for that one day. The next day, you may make a loan repayment, you may receive money from someone, the cash balance in your bank may change. It will be a different figure again. So the balance sheet, that balance word, where the liabilities and assets are exactly the same, that is something which happens only on that day, the day you prepare it. You can see, in theory, you can prepare it on any day. But the law requires that you prepare it on the 31st of March. Because our financial year is from 1st of April till the next year, 31st of March. Now, the other feature is it will always balance. And the accounting equation is assets is equal to outside liabilities plus owner's equity. Owner's equity is promoters plus shareholders, everyone. Outside liabilities is everything else. Everything other than the equity, the debt component, the current liabilities, everything that you have is outside. And all the money that you borrowed, either short term or long term, that part is your outside liability because it is outside, it is not yours. Owners are inside, they are the owners of the company. That is the distinction between outside and inside. Okay. What are assets? Assets are resources that help the company to generate revenue, like you were saying in the last slide. Examples of assets. What examples can you think of assets?
Land, building.
Okay.
Machinery.
Great. Raw material.
Goodwill.
Okay. Intangible. You're getting into the intangible area. But take the simpler ones. Take, for example, cash in the bank.
Cash in the bank.
That is also an asset. You can take the stock which you have bought, the raw materials that you have bought, the finished goods that you have, those are also assets. The computers that a service organization has. Let's say there is a legal consultancy company. One of the things which it will have will be lots and lots of computers. Those are also assets. The tables, chairs, furniture, those are also assets. In a bank, the safes are also assets. So everything which has a certain, let's say, structure, physical or non-physical, if it's intangible, all those are assets. As long as I have bought those assets for the company. And what are the liabilities? These are obligations to repay money or render services in the future. Now, this creates a slight complication in your mind. Liability is an obligation to repay money. This is simple enough. If I have borrowed money from someone, I expect to repay. If I have sold shares to someone, it is a liability because at some point I am expected to give him dividends. If I wind up my company, I am expected to return the money to him. So that is very clear. But why do you think this is there? Render services in the future?
As we have taken the money and we need to give the service.
Exactly. It is an advance. You have received the money as an advance. That money is lying in your bank, but it is not yours. So that particular thing, it will increase your cash balance. But on my liability side, I will write, okay, this is an advance payment. So in that way, I will basically, this is why it always matches. Whatever I do on one side, it will have its reflection on the other side. Now, this advance that I receive, I am not expected to repay it in money. I am expected to repay it through the service that I have, whatever I am giving. Okay. Now, let us look at the balance sheet. So let's say this is a company, Messrs. ABC. This is for March 21, 31st March, first point. So liabilities, sources of funds, assets, application of funds or uses of funds. Now, capital. First big liability, capital, equity capital. This is the owner's equity, 500. Okay. Long-term borrowings, 1,000. In this simple example, this 1,500 rupees that we have are long-term. Long-term generally means something which is, technically speaking, it is basically more than 1 year. But in practical terms, it is much, much longer than that. For example, the capital or equity, this part here, this is seriously long-term. This is going to be there with you till your company exists. This is not something which has to be returned at any point. Long-term borrowings, it will have a certain period. You may have taken it for 5 years. It will, as you repay it, it will keep coming down. Okay, but it should be more than 1 year. If it is less than 1 year or up to 1 year, it will go into the short-term category. Okay, now, due in 1 year, these are called current liabilities. The word current here simply means within 1 year. That's all. Now, the first example I am giving, this is because I am a banker and every company that we have will normally have some line of credit from the bank. That means they can borrow from the bank and as they sell, they can keep returning the money. And then if they want the money again, they keep taking the money. So it's like a rotation. Like for example, if you have an overdraft account, on a personal level, if you have an overdraft account with the bank allows you to continually revolve the money. You take, let's say you have an overdraft account backed up by, let's say, your FDs. You have some fixed deposits of 10 lakhs. You decide to have a overdraft account of 5 lakhs. The bank opens an account for you. It gives you a checkbook. It gives you a debit card. You are all set to spend money. You take up to 5 lakhs you can take, but you don't need 5 lakhs immediately. Maybe you take it in small chunks. Sometimes you take 10,000, sometimes 20. And meanwhile, as your salary comes in, you can keep depositing money. So the balance will keep fluctuating. Now, that same concept in the bank, the facility which the bank gives to a company, it is known as cash credit. So typically, a company will have a cash credit account and it will have a large limit, 1 crore, 2 crores, 3 crores, like that. They will use that money to buy raw material, to pay salaries, etc. And as they make sales, they will keep depositing the sale proceeds in the cash credit account. So that at any point of time, the balance in that cash credit account or the borrowing in that cash credit account does not go beyond the limit. If the limit is 2 crores, it should be operating within 2 crores. Interest will be charged just like in any other borrower account, and that interest is paid by the company additionally. So all this happens in 1 year. After 1 year, the bank will also renew this. You will give your financial statements to the bank. The bank will look at the statement of account of the cash credit. If it is satisfied, it will renew the account. If it is not satisfied, it will ask you to get that account from some other bank so that it can adjust it. That's the point. Accounts, bills payable. What is this? Why is it a liability? Anyone?
The payment which you have to make it.
You have received something. Maybe you have bought something on credit. Why does this happen? In the market, whenever you go, I'm talking about the wholesale market. Whenever you buy something, generally companies for bulk purchases are willing to give you a certain amount of credit. Every trade has its own custom. If, for example, you're into buying cotton and you're a textile mill. So when you buy that cotton, there is a certain period which is given to you for making a payment. Nobody is expected to have the money immediately. That period can be 1 month, it can be 2 months, it can be 3 months. So this is being prepared on the 31st of March. Let's say on the 1st of March, you bought this 5 lakhs worth of something. And it is payable in April. So on 31st March, you have not paid this as yet. You have received whatever material there was. You are using that material, but you have not actually paid it. So it will reflect as a liability because it's a source of funds. It is this source which allowed you to get the material. And where is that material then? That is going to reflect when we come to this side, to the asset side, that will reflect that side. Whatever it was, let's say it was cotton, it will reflect in the item stock, okay, or raw materials, whatever it was, it will reflect this side. Now, taxes payable. This is something which you have to pay. Therefore, this is something which you have to put down here. Now, salary is payable, interest payable. You have loans from the bank. You see, you have a cash credit here. You have long-term borrowings. All of these attract interest. Therefore, interest payable, rent payable. At the end of the month, you will have to pay rent. So logically, if you have only one particular premises, the rent of that premises for March will be paid in April. So in March, as on 31st March, this probably reflects the 1 month's rent. Okay, then dividends paid. This is again something, if dividend has not been paid, it is going to come here. Now look at the asset side. You got these long-term funds, 1,500. How are you using this? Land and buildings takes up 600. Machinery takes up 200. And office equipment and furniture takes up 10. Investments in other companies. Sometimes you may get an opportunity to invest maybe in a sister concern and you feel it is profitable, so you are giving it there. Now what you can notice here is that the total of this is 900. The total long-term funds I had was actually 1,500. So where is the rest of the 600? A shortfall here of 600. This is being used to finance my current assets. Because some part, like the current assets, some of it, okay, let's look at the nature of current assets. Cash, 50, this is in your bank. Inventory, that means this inventory is a general word used for anything which is, it could be raw material in the case of a manufacturing company. It could be, something like, let's say it's a trader's shop. He's dealing in medicine. It could be stock of medicine for a trader's shop. It's a kirana shop. This inventory could simply be the list of different kirana items that he has. So depending on what the nature of the business is, this inventory will be related to that. Bills receivable, 200. What are these bills receivable? Anyone?
Sir, if we have given advance to anyone, any company or concern, so we will be getting it.
No, not advance. If you have sold something on credit.
Whatever the.
Yes, Saurabh?
Sir, whatever the products or the assets which we had given to our kind of like dealer or distributor, and
yes,
we are getting the payment for it.
And then tax refund receivable. I'm just putting these different things here just to tell you that these can be different. Why is it an asset? Because this is receivable by you. You're going to get this money. Okay, that's why. Then, if I now total this, I get this 625. Now, coming back to my question, if this is totaling to 900, this is 1500. So the difference of 600, I am investing in my current assets. So as you can see, these current assets are not all cash. 50 is cash. But this 450 and this 200, these are not cash. This 25 is not cash. These are expectations that you have. These two especially. The 450, before this becomes cash, it has to be processed into a finished good in the case of a manufacturing concern. Only then will it become cash. See, if the raw material is there or some work is being, work in progress, it is in the line, in the factory line. So it is not finished yet. Some part of it is finished goods. So when everything is finished goods, it will be sold. After it is sold, you will have to sell it on credit. It will become a bills receivable. And then only then will it convert into cash. Now what happens is that while these things are being converted into cash, some of these bills will come up for payment. Some of these bills here will come up for payment. Salaries have to be paid, interest has to be paid. And in that case, where do I get the money from? So I have to have some stable source of fund, which is, I cannot rely on collecting my bills receivable, like sending somebody and telling they will go and collect from somebody I have sold my goods to my buyers. Okay, pay me fast. If he doesn't pay you, you will not be able to pay your salaries, you will not be able to pay your own bills paid. This is going to create a problem. Therefore, you need some surplus cash. And that surplus cash is normally maintained from my long-term funds. That way, what happens is that I have always sufficient liquidity. I am not at the risk of becoming a defaulter in paying my own bills, like that. Okay, so that was my balance sheet. Now we come to our...
Sir, just a question on the last point. Sir, if you are having a surplus funds, then how this balance sheet will match what you are telling, na? That to maintain.
This, see, it is not surplus in any way. Na? It is not surplus in the sense that it is lying somewhere else. It is here. The only thing is, it is in my assets. I have used those funds to buy inventory. It is on the strength of those funds that I am able to give credit to people. It is all here.
Okay. Good.
Now you come to your profit and loss statement. So this is also known as a income statement, even though it has a column for expenditures, but it is referred to as an income statement also. Now, income or revenue, same word, same meaning. Income or revenue is the amount of income generated by the business. Where is it coming from? It is coming from sales. You are selling something. So the sales figure of a company is shown as income. Please understand, this income is not profit. It is an inflow. All the inflows that you are getting, incoming, it's coming in. That is income. So for a manufacturing company, the sales of its goods will generate income. When it sells, it will receive something. So it may receive cash, it may receive a commitment to pay, bills receivable. So if you are allowing a certain period of credit, then what is happening? You are allowing that person certain time to pay. Meanwhile, in your balance sheet, you are treating it as a receivable. So it is still income. It is still income that way. Now, for a manufacturing company, sales will generate income. For a software company, the sales proceeds of its software programs, license fees for using the software. Like, for example, you go to, you buy, let's say, Microsoft Word. So when you buy Microsoft Word, you are buying a software program, you are paying it. For Microsoft, that is a sale, that sale is an income. Company like Reliance Smart, it would be the sales proceeds of the goods that it stocks. You go to Reliance Smart, all those goods are there. Every time you pay, they are making a sale. In their profit and loss statement, that sale is going to come under the head income, because that represents an inflow of cash. So just go by the word incoming. That is the best way. Income is not profit. Income less expenses is profit. So I should not get confused that income is mine. In fact, many businesses are bankrupted because the owner treats the income, whatever comes, as his or hers, without considering that there is a lot of expenses to be paid. As a banker, I know this very well. Without considering the installments to be paid to the bank, people buy cars. They go and buy a car, they do go on a foreign trip without understanding that whatever money they have got, that income is not theirs. It is something the company has earned. They are only entitled to the profit. Okay. Expenses on day-to-day operating expenses are recorded in the profit and loss statement. So look at this profit and loss statement here. Please disregard this. Just look at the words which are coming on your screen now. The items are here, amount is here. Okay. And subtotals. Sales, correct? 10 lakhs. Cost of goods sold. For a manufacturing concern, this item is there. So cost of goods sold, or COGS, this includes cost of raw materials and labor related to the production of the goods. So basically, all the salaries are not shown here. Only the specific labor input which went into the production of the goods. You can think of it like this: all the workers working on the factory floor, on the shop floor as it is called. That part is here. All the expenses, for example, the spare part maintenance, the fuel which is used, all that will come in this cost of raw goods, cost of goods sold. Now, if you reduce these two, you will arrive at the gross profit. So this is simple. My manufacturing cost is 6 lakhs. I sold it for 10 lakhs. And I'm getting a gross profit of 4 lakhs. Is this 4 lakhs actually profit which I can take home? No. Because there are still a lot of expenses which these operating expenses have to be paid for. In many companies, the problem is in this part. Too high, too many operating expenses. What are the typical operating expenses? Rent, 50,000. Power bills, electricity, salaries and wages, marketing expenses, interest expenses, depreciation, your things are losing value, insurance, conveyance. So my total operating expenses comes to 161,000. Now, if I reduce 161 from 4 lakhs, I get my operating income. What is this? This is profit from the business. This part is profit from the business. This is actual profit. Okay? This is actual profit. One thing you have to, we'll come back to one more thing. Will this amount be there in my bank? 239? Not necessarily. This entire amount may not be in my bank, because you have made some credit sales also. There are some people who have not paid you as on this date, by 31st March, because this is for the whole year. During the entire year, you made sales of 10 lakhs. These goods were produced at a cost of 6 lakhs. These are the total, rent and power and salaries, etc. you paid to your employees or to the provider during the entire year. And those expenses came to 161,000. This is always actual. This is never something which is not paid. This is actual. You have to pay. You will have to pay your landlord rent. You have to pay the electricity bills, the telecom bills. These will actually be paid. And this part here, these 10 lakhs, this is something which is the commitment sometimes. If you have, a business like a sweet shop where everything is cash, then it's good. There's no problem at all. Everything is cash. I was helping a local business here. They sell kirana and vegetables to make their profit and loss account. So he has no receivables. He has no payables. Everything is cash. So you can take this gentleman's bank account and from that simply segregate and you will get your entire profit and loss. Because everything which he is doing is very well reflected there. It is all cash. But in most businesses, sales are a figure which you sold it for 10 lakhs. Did you get the money or not? That is something which is to be ascertained from your balance sheet. Because whatever is receivable will not be here. It will not be in your bank basically. Okay, so I have made a profit of 239 from the business. Non-operating income. Like remember when we were looking at the balance sheet, we said that some part was invested in another company. If you invest money in a different enterprise, it may be a sister concern. It is different from this business. It is different from this business. It's a separate business. Therefore, it is treated as non-operating income. Operating means operating in your business. Whatever is used inside your own business, that is operating income. Non-operating is any investment made by you outside. Now here, interest on investments are 51,000. You had invested somewhere, you were able to get 51,000. So the total non-operating income comes to 51,000. Okay. Now you can say that why this 51,000, if it has nothing to do with the business, why is it shown in this balance sheet? Because we are trying to think of the balance sheet of a company. The company is a legal entity. If an investment was made in the name of the company into another company, then whatever your company received by way of interest, that has to be reflected in its own balance sheet. But since it is not part of the core business, therefore it is shown in a separate category of non-operating income. Is this point clear to everyone?
Yes, sir.
Can we call it a net worth, sir, net worth of the company?
Yes, sir.
Can we call it a net worth of the company?
No, this is not net worth. This is the net profit of the company. The net worth of the company is to be ascertained from the balance sheet. Basically, when you talk about the net worth part, it is the long-term, the owner's equity part. The shareholders' funds, owner's equity, reserves and surplus, that is net worth. That's all. This part here, this is about net worth. Always sort of remember, those are concepts which are used and which can be obtained from the balance sheet. Because net worth is about assets and liabilities. That shows your worth. This is only about 1 year's details of accounts. What happened during the year? What did you do during this year? So you use the funds to produce 6 lakh worth of goods. You sold these goods for 10 lakhs. And then after meeting all your expenses, you were able to get an income of 2,39,000. And then you also got interest from your investments of 51,000. And in the process, you were able to arrive at net income or net profit of 2,90,000. So not net worth, this is net profit. Clear, Saurabh?
Yes, sir.
Okay, now this particular concept, you just have to remember that in this is for 1 year only. Now, whatever profit you made, this can be reinvested in your company. See, if you decide to expand your company, you can take this 290 and you can put that entire money back, make it part of your capital. Whatever capital you had, you add this to your capital, it will increase. Remember that when we were looking at HCL, that reserves and surplus had come. So this can go into reserves and surplus and it will reflect in your balance sheet. Alternatively, you can take some part of this and you can give it to your shareholders as dividend. So the whole concept here is that this money out here can be used for the purpose of either paying dividends or it can be used for investment within the company. This is money from your operations. Operations are your business activities. From your business activities during 1 year. Which year? The year ending 31st March 2021. In this 1 year, from 1st April 2020 till 31st March 2021, this is what you did. When the auditor comes, he'll be looking at each and every voucher related to each and every transaction. Each and every payment that you made, each and every income that you received. And if he puts his stamp on this means that these figures for each of these heads are correct. And that means that you have actually made this profit. Now the catch here is that if you have too many debtors, that means if too many people, if you have sold too much of your goods on credit, then this profit will not reflect in your bank. Bank account may be less. You may be having lots of certificates telling you, like commitments from your creditors, where they are promising to pay the money to you in the next 1 month, 2 months, etc., but which you have not received yet. But for the purpose of understanding whether you made a profit or not, on your books, this is a book profit, you prepare this. Remember in the earlier sheet that we had, in the balance sheet, we had this figure, bills receivable. Okay. This bills receivable part here, this is the part which actually tells part of the story. If this figure is very high, this means that your cash is going to be low. Cash means including bank account, this is going to be low. If this is very low and this cash is very high, then you are doing good business. Then that means there is a balance between the cash sales and the credit sales, or whoever you are selling, even if you are selling on credit, they are very, very prompt in repaying. Okay. So this part here is the profit and loss, and now we come to our cash flow statement. Last thing that we can touch today is this. What is this cash part? This tracks just the movement of the cash. So this is not looking at anything which is committed. Like receivables or payables will not be reflected here. Divided into 3 sections. Cash from operating activities, cash from investing activities, cash from financing activities. So the business activities are divided into 3 parts. Main part is that operating, investing, and financing. So cash from operating activities, these are inflows or receipts of cash. Sales of goods made by the company or services provided by the company. For this, you received money. Actual money if you received. If it was credit, it will not come. Whatever cash you received. Remember, this is all about cash. Cash from operating activities, payments of cash. These are outflows. Remember, we are talking, since it's a cash flow statement, it is taking into consideration inflows and outflows. So the cash outflows are here. Payments to suppliers. Whatever you actually paid, if you got credit, if you got some raw material on credit, then that will not come here. Payments of all heads of operating expenses, rent, power, salaries, these obviously will never be credit. You have actually paid this. This represents an outflow from your bank account. So it is coming here. Then cash from investing activities. Now, investment refers to purchase of assets like machines, computers, etc. So these are investments in your business. So this is the asset side. Remember when we said that long-term investing part, that is coming here. Amount paid for purchase of machines, equipment, it can be vehicles, computers, all those things. These are outflows. Amounts invested in a bond or share of another company. That is also a investing activity. Sales of these assets will lead to an inflow. Yesterday, one of you had said that in a machine, at the end of the life of the machine can be sold for some scrap value. I think Saurabh was making this point yesterday. Now, that sale, when you make it, it will result in an inflow, no matter how small it is, it will result in an inflow of cash. That cash which comes into the company, that will be shown here in this investing activity part. So remember, this investing activity is mostly about this. This is an exception where you are actually putting money in another company. If you leave this out, it is basically about your own assets, purchases of assets, sales of assets. And then financing activities are loans taken from banks, other creditors. These are inflows. When you borrow money, you receive money. And this will always be cash. If it is, see, whenever we say cash here, it includes any credit made in your bank account. And loans repaid or interest paid. These are outflows. Whenever you pay a loan installment, you repay a loan in full, or you pay interest, that represents a cash outflow. So the cash flow statement basically records this. This is the basic function of the cash statement. Now, to give you, we have a little time, I'll just show you an example of this. Okay. So here, operating activities, inflows, outflows. Cash received from customers, 10 lakhs. Paid to suppliers, 2 lakhs. Salaries paid, other operating expenses, 50,000. What is the net position? 10 lakh minus 4 lakhs. I'm getting 6 lakhs. Investing activities. Sale of land. Land is an asset. Land was sold. I received 5 lakhs. Purchase of equipment. Outflow. I bought machine. I paid in cash. So the net position is 6 is an outflow. 5 is the inflow. So this is a minus figure here. Okay, that's why it's reflecting an outflow. Financing activities, dividend paid 1 lakh, it's an outflow. Loan installment repaid 50,000, outflow. Net cash from financing activities, again minus figure 150. Now, if I total these, what am I getting? This total will be 6 lakhs. I'm taking the net figure only. And this side it is 250. What is my net cash position? 6 lakh minus 250, 350. This amount has flowed into the business. Purely in cash terms, without getting into any other complication. It shows that 3,50,000 has flowed into my business. Now, this particular thing, if you look at it now as like an auditor, the auditor will say that you would have been in deficit had you not sold land. Think if this 5 lakh had not been here, and this 6 lakh you had spent on machines, then the net position here would have been 6 lakhs instead of 1 lakh. In which case, this 350 would have been minus 150. 5 lakhs minus 350 is 150. In which case, you would have been a cash deficit company. In that year, more cash would have flowed out, less cash would have flowed in, which is not a good trend. If you are doing well, all good companies, if you look at the cash flow statements, this is a positive figure now. Only then can you say that they are doing well. Otherwise, it means that something is wrong. Either they are giving too much credit, and then it means that they are going to come up with some cash problems. See, if you don't have cash, you will not be able to pay dividend. Dividend is always paid in cash. And if you don't pay dividend, it means your shareholders will be unhappy. And if your shareholders are unhappy and they begin selling your shares, your market value is going to come down. So, basic point I'm trying to make is this net cash position should always be positive. In this example, it is positive, but you have been saved because of the 5 lakhs which came in because of sale of land. Every year you will not have land to sell. Sale of land is a one-time thing. Sometimes.
And also the sale of land, like this is a personal asset. This is not related to the operating business. So, like, why the sale of land should be, like, in our cash flow
because
statement?
It belongs to the companies. Because you are showing this land up till last year, you were showing this land as your company's assets. In the land and building column, you are showing this as your company's assets. So what is happening here is you are not selling something which you are producing, but you are selling an asset. When you sell an asset, it means that it is reducing your capacity in the future to generate income from that asset. Like, for example, if you sell a machine, it will reflect here. It will definitely reflect because the machine is on your balance sheet. The machine is being shown as an asset. But even though it is not a core business activity, land surplus that you had surplus land, that's why you were able to sell it. It has to be shown here because in whose account did the money come? Money came into the account of the company. And what we are interested here is what cash came into the account of the company, what cash left the account of the company. Since this cash came into the account of the company, it has to be shown in the cash flow statement. But like you said, since this is something which the company does not actually do, this is not its core activity. Selling land is not its core activity. If my cash flow is increasing because of sale of land, it means it is a one-time thing. And if you look at, over a long period of time, if you look at different companies, many companies are sometimes showing good, results, especially in the cash flow side, mainly because of sales of assets. You think of a company like DCM, Delhi Cloth Mills, used to be a big name when I was a young guy. In those days, DCM had a lot of property in today's Purani Delhi. DCM Mills and all were there. Now, when DCM sold this, when DCM sold that mill, it would have sold in hundreds of crores. Now that at one point of time, that would have been their main factory. But they shifted somewhere else. That remained with them. When they sold it, in that year's cash flow statement of DCM, those 100, 200 crores, whatever the amount was, will be reflected. Now you can say that that is not DCM's activity. But the money came into DCM's account. Therefore, it has to be shown in the cash, because in this statement, we are not saying that we are only talking about what actually is being sold. We are talking about what you sell and your assets and your fixed assets also. Okay, so these three statements give you a good idea of what financial statements are and exactly how we use them. And see, a lot of information is coming from these statements, and this information is being given to the authorities like the ROC, SEBI. It is generally published. If it's a public listed company, this will be published in the newspapers. It will be put on the website of the company. So every attempt will be made to put this in the public domain so that everybody can see. This is part of the the attempt to be transparent in your dealings, so that the whole world knows what you are doing and what your results are. Apart from being a very good source of information for the company management itself. So the company management, when they look at these figures, they will also notice this. Like for example, just as you said that this 5 lakhs is something which is not part of the actual core business of the company. The management will also notice, yes, this year we have been saved because of the land sales. Otherwise, we could have been in trouble. Saurabh, also to satisfy you, this 5 lakhs will not reflect in the profit and loss statement. Note this. So this 5 lakhs will not reflect in the profit and loss statement, which deals with the operating side of the business, with the actual business activities, because it is not sales. But this will reflect here. And where else will it reflect? This 5 lakhs will reflect in the balance sheet. In the balance sheet, asset side, 5 lakhs will go down. Land and building column, 5 lakhs will come down there. And if these 5 lakhs are actually available in the bank account, that part will go up. So things will change in a number of places. So with that, I come to the end of...
Sir, sorry to interrupt you. Can you please just extend that calculation again?
Which one?
That calculation, the calculation cash flow statement. Sir.
This one?
Right, sir, right.
Okay. See, it's very simple. Nah? You look at this, the subtotal. 10 lakhs minus 4 lakhs is 6 lakhs. I'm writing 6 lakhs here. 6 lakh minus 5 lakhs is 1 lakh. And here, there is no inflow for financing activities. 150 is the outflow. Now you just add the subtotal. 6 lakhs, 6 lakhs. Here, 1 lakh plus 150, 250. 6
so sir, after, sorry to interrupt you, sir. So after selling the land, so the 5 lakh rupees amount which we received, so that will not count in the inflow. So 6 plus 5 should be 11 lakh, right?
Once again, after selling the land?
Yes, after selling the land, we received the amount of 5 lakh rupees, right?
We received 5 lakhs, yes.
Correct. So then, because we have remaining 6 lakhs and then 5 lakhs, that it should be 11 lakh inflow.
It's an inflow, so I am adjusting it with this outflow. 6 minus 5, I'm getting 1. Okay. See, each of the segments, I am getting you the final figure. Here, inflow minus outflow is giving you 6 lakhs. Here, outflow minus inflow is giving you 1 lakh. And here, since there are no inflows at all, the total of outflows is 150. So my total outflows, after considering the inflows, is 1 lakh, 150. This is 250. Here it is 6 lakhs. 6 minus 2, 350. Segment wise, यहाँ 6 surplus हो गया, यहाँ 1 deficit, यहाँ 1.5 deficit, so 250. You are left with 350. Okay.
Sir, actually, like my question was, see, because there's a two amount which we received. One was cash received from customer, and another one was the sale of land. So total we received is 11 lakhs. Sorry, 10 and 515 lakhs.
Okay.
And the outflow, like, because the cash flow to suppliers, salary paid, and other operating expenses is 4 lakhs. And 6 lakhs rupees is the purchase of equipment. That is total 10
then
lakhs.
It will come to the same figure. Na? See, even then you will reach the same figure. If you want to do it that way also, it will be the same thing. You will get 15 lakhs here, and here you will get 4 lakhs plus 6 lakhs plus 150. So it will be 1150. 15 minus 1150 will give you 350. It's not different. No?
Okay, sir. Okay.
I am just making it easier for you here by giving it to you segment wise. That's all. So that is just trying to show it to you for each segment. What is my inflow from? See, the question here, it answers is from my operating activities, were my inflows surplus or were they in deficit? What this is telling you is that in your main operating activity, you had a 6 lakh net cash. It was positive. In your investing activities, you were down by 1 lakh. And in your financing activities, you were 150 down. See, financing activities now will always be negative because you have to pay. You have to pay there. Unless you are taking a loan that year, these financing activities will always be negative. But what this tells you is that your operating activity, your main business, that is doing well. No? There you are getting a 6 lakh surplus. Good. This part here, every year you will not buy equipment also. And every year you will not sell land also. So this is something which has happened during this year. Fortunately for you, because you have sold land, the actual outflow of funds is only 1 lakh for investing. And this financing activities, this will be there every year. Every year you will pay dividends. Every year you will pay loan installments. So as long as this is good, if this part is good, it is telling you that the core business is good. Okay. Understood this?
Yes, sir.
Okay. Then in that case, we will stop this here. So the purpose of these 3 sessions was to give you some exposure into some of the financial management concepts, time value of money, discounting, capital budgeting, and also give you an idea about a very, very quick idea about financial statements, mainly these 3 statements, how they are prepared, what to look for in a balance sheet. Very, very short overview of this area. What I sincerely hope is that this has been of some help to you. And tomorrow, if you look at a balance sheet, at least you will be able to make some sense of it. Okay. And those of you who continue with finance will meet when the regular sessions start. Meanwhile, it's goodbye for now. All the best to all of you. Whatever particular specialization you have chosen, continue to proceed with that, do it properly, and more power to all of you. Do things well and do well. So good night and thank you.
Sir. Good night, sir.
Good night, sir. Good night, all.
Good night.